Okay, so we'll start with
Hi.
Esther and then we'll bring him just now. Hi, Esther, how are you?
Good, thanks, and you?
Great, thank you. Can you please tell us a little bit about just who Esther is so we can get straight into our conversation?
Yeah, sure. Hi, Nicolette. Hi, everyone that's online. I'm so excited to be here. Thank you so much for affording me the opportunity. So, who is S? Well, I'm a working professional, so I do have a full-time job. You were talking about income earlier. So I earn an income from a full-time job, a salary. I do have my side passion, which is obviously personal finance and just everything to do with investing. So that's my other passion that I'm, passionate about. I'm a mom of 2 kids. I have a boy and a girl. I'm a wife. I do so many things. I sit on boards. That's my other passion. So I just do a whole lot of things that I'm passionate about, and I just go full force. That's literally me.
All right, it's very exciting. I didn't actually know that you are a mom, so that's quite exciting considering the amount of stuff that I see you doing, and I'm always like, how do people do it? How do you guys with kids do all of the things that you do and still be amazing moms to your children?
Listen, you need a support structure. Hey, I cannot do what I do without a support structure. My mother, my siblings, my husband all chip in because they know this is what I'm passionate about. So they're willing to support my dreams and push me going forward. So I really have a great support system that I'm grateful for because there's no way I'd do what I do without them.
Absolutely. That sounds fantastic. Let's talk a little bit about paying yourself first. I mean, the idea of paying yourself first is quite a difficult one for people to grasp because a lot of people think when we talk about pay yourself first, they think it's go and buy nice things for yourself. If you can just explain what pay yourself first is to us.
So, Nicolette, when we know what this question comes up, I always think of this. For me, paying myself first is about prioritizing my future financial well-being. So rather than focusing on the now, I'm focusing on the future. So yes, I must enjoy now, obviously, with what I'm getting. I must put aside something to enjoy, but the rest is something I put away for my future. I'm building something for my future that will pay me in the next few years, that I'll start earning an income from my investments, from my assets, that, in this current environment, what COVID has shown us is that, income is not guaranteed. You can lose your job, you can lose your income source. So I'm just trying to literally, if you're on this path, you're just trying to mitigate financial lack in your future, and you're just putting something away. It doesn't matter what amount it is, but you're basically saying, I want to put something away for my future that will sort of cushion that financial lack or financial emergency that might happen in the future. So for me, Nicolette, I like to always give examples. So for me, for example, I've been investing for the last 3 years. And it's so amazing that for the last 3 years, I've been putting, I know I'm privileged. I've been putting around 2,000 to 3,000 Rand away. And it's amazing to see that I've accumulated 183,000 Rand. And of that, literally, I'm earning now a annual dividend income of 10,000 Rand. Money that I didn't work for. It's my money working harder than I do. And it's literally money that's earning me. My investments are now earning me an income on an annual basis that I don't have to work for, that I don't have to trade my time for to earn that income.
Yo. So explain this strategy that you've got put together that can get you to earn 10,000. Now that's something really worth us getting the secret into it.
No, sure. So what I've done is that I've looked at, you look at your different investment objectives as an investor. You ask yourself, what is my investment strategy when I'm investing? Because you're just not investing for the sake of investing. You want to put together an investment strategy that will help you. Now, I like to have what I call the 5 principles. Basically, it's a set of rules that you have for yourself that help you navigate when you're trying to build an investment, an asset, an investment income, an investment portfolio. So I like to think of the 5 assets. The first one is your objective. What are you trying to achieve? So for me, in this particular instance, I'm a dividend income investor. So I look at companies that I know pay a good dividend yield, what we call dividend yield, which is basically the dividend income the company pays per share divided by the share price. That gives you a dividend yield. So I'm trying to buy companies that are really good dividend payers. so that they can give me an income. And examples of this that I have in my portfolio are like your Kumba. Kumba has a great dividend policy. They pay, I think they have their dividend yield is over 7%. So I know they'll give me good income. I like companies like Exaro. Your miners this year have done really well. So those are some of the companies I've gone for, knowing that they pay good dividend income. The other principle, the second principle, so the first one was objective. What are you trying to achieve with your investments? Are you trying to get income? Are you trying to grow your portfolio, your net worth by investing in companies whose share price will grow over time? And that's how you make your money. The second one is understanding your risk profile. Now, investing always has, there's a risk reward. And you always have to look at what level of risk are you willing to take to get a particular type of reward. That is very important for you to consider. I mean, if the sound of crypto, Bitcoin, Ethereum makes you nervous, maybe you're not an aggressive investor per se. So what level of risk are you willing to take to get a particular reward? And it's very important to understand what level of risk or what type of risk profile you are. Now, I'm a moderate to aggressive investor, so I'll go for companies that are very risky, but I know over time I'll get a return. And then I like my dividend income, which they've grown, they've made their mark, they're mature companies, they've got steady cash flows, they can pay me dividends, and some of those that I've mentioned earlier are like your miners. Then the third thing you must consider is asset class. Now, I always ask this when people ask me, I want to invest, but I don't know what to invest in. And I always ask, what asset classes, because what asset class do you want to invest in? Now, different asset classes give you different type of return. What I mean by that is if you look at cash is a type of asset class. Now, if you put your money in a bank, for example, in a savings account, you're going to earn probably between 1% to 6% or 4% if you're lucky, in terms of your interest income that you earn on your savings account. Now, that's cash. If you put your money in a different type of asset class, like a property, your level of risk is higher. So what you earn from that will be a little bit higher than putting your money in cash. You get your rental income. If you're invested in listed properties, you get your quarterly dividends that the REITs pay on a quarterly basis. The other asset type classes that are there is equities. Now, there's different type of equities. There's penny stocks. Penny stocks are usually companies with market caps of less than 2 billion. So literally the share price times the number of shares outstanding that the company has, that will give you a market cap. Now, if it's less than 2 billion, that's considered a penny stock. Penny stock like your Purple Group, who owns Easy Equities, are penny stocks. Penny stocks like Avenge are considered penny stocks because they've got a market cap of below 2 billion. Then you get to the sexier stuff or the less risky type of equities, your mid to large cap stocks. Now, for example, Kumba is above 2 billion. Its market cap is quite big. MTN is considered a large cap. So those are considered less risky, and their income is more steady state. They're mature, they've done most of their investments, they're now paying some of that money back to shareholders. So those are the different asset classes. And if you really want to be more sexy, you can go for the alternative investments like farming. I know Fed Group offers you to buy blueberries and the likes. And then you also get venture capital, where you're an angel investor and you invest in new startups. Now, those are very risky because we know that startups have a high failure rate, but the returns, if you get it right, can be quite amazing. So different asset classes give you different returns, and you need to understand what sort of asset classes can I buy, and you need to sort of mitigate your risk by investing in different asset classes, because by doing that you're diversifying yourself so that if property doesn't do well, your cash is still there. Your emergency fund in the form of cash is still earning you an interest. You can have property which is giving you rental income. Even if your shares are not doing too well, you still have that rental income coming from property. So that's the third one. The fourth one is time. You need to understand how much time do you have. You can't come, I know most of the questions I get is, I've got 100,000 rands, I want to invest, but in a year's time, then I want the money back plus some form of return that I would have gotten. If you're going to invest, look at it above 5-year period. If you want something quick, rather look at maybe putting in a money market fund or a savings account. So it's money that you want to invest with must be money that you're willing to put away for a longer period than a year, most likely above 5 years, to really get the good growth that you want to see and the good return that you want to have over time. The fifth one is tax. You cannot do investing without considering the tax aspect. And one thing I know I always punt is that if you've got, let's say your pension fund or your provident fund at work, the next thing for me I look at to supplement that retirement is the tax-free. Now, government has said, you know what, in a tax-free you can have it with a bank, but I don't recommend you have it with the bank because the bank, SARS already gives you, I think it's 23,800. If you have it in a savings account and you've earned interest of 23,800, you already don't have to pay SARS anything. So for me, that's why I don't like a tax-free in a bank. I prefer having a tax-free with where it's either in an exchange traded fund, which is basically a basket full of shares, like your Satrix top 40 will have the top 40 companies on the JSE. So it mitigates your risk. It grows like equity. So the return you get is above the 6%, which your savings account will have. So a tax for me is a big consideration. I want to take advantage of tax. I pay a lot of tax as a salaried employee. So I want to find ways of, reducing my tax bill at the end of the day. And one of the ways I do that is making sure I have a tax-free that I buy exchange traded funds in. That way I sort of I save on the tax aspect. Whatever dividend income I earn in a tax-free is not taxed as long as it's a South African company. As long as it's a South African exchange traded fund. Now, if it's a foreign exchange traded fund, unfortunately, it's not governed by the South African law, so therefore the dividend income from there is taxed. And the other thing I consider is how can I be more tax efficient? You know that you've talked about an RA, I won't go into that, but those are the 5 principles for me that are very important. I'll just recap. What are your objectives? What are you trying to achieve by investing? 2, understand your risk profile. There's a level of risk that you must take in order to get a reward. 3, asset classes. There's different asset classes. I know a lot of us only know about, property and savings, but there's so many asset classes that you can play with. The fourth one is time. You need time. Money compounds. Einstein said compounding is the 8th wonder of the world. It requires time. You cannot do something quick. If you're doing something quick, chances are you're not going to make as much money as you want. And then 5, tax. Those are the considerations you need to take into account when thinking about your investment objectives. Once you've considered all of that, then you need to look at, do I want dividend income? So maybe you'd want to buy more exchange traded funds or companies that give you dividend income like I do. And I go for the miners. The miners have done really well this year. Hence, I was able to get that 10,000 Rand that I got. My portfolio and my South African portfolio is around 200,000. Which have amassed over the last 3 years, as an example. And in that South African account, my dividend income for the year has been 10,000. And companies that I've bought, and dividend income, remember, is the number of shares you have multiplied by the dividend that the company sort of declares. So it's literally the number of shares multiplied by the dividend amount declared by the company. So for example, this year, Exxaro declared 70 Rand per share, and I owned around 15 shares. So I was able to get, over 1,000 Rand in terms of my dividend income from that one company. I obviously had other companies like Sibanye, Exxaro, Standard Bank, and the others that also gave me dividend income. So it's just about diversifying and understanding which companies pay large dividends and then going for those because I'm a dividend income investor.
I love that. I love how you say, y'all don't know, but I'm a dividend investor, because it's so, what's the English word that I'm looking for? It's so encouraging to be able to see somebody who's investing in a paper asset like the stock market, being able to derive that income that comes in every single month, right? Because a lot of us, we invest in the stock market either using a unit trust or an ETF that is being maybe administered by like an Old Mutual or a Sanlam, and it's always so difficult to see your dividends coming in on the different companies that you have bought. So you think nothing is actually happening in this thing, right? So maybe if you can just take us through the 3 different things I've just spoken about. I want to welcome Salem Nyati to our conversation. She's going to be talking about debt. So I'm just going to wrap up with Salem, and then we'll bring you in to have a conversation around debt. But I wanted you to be on stage so everybody can see your face and they can get a better understanding of who exactly is going to be talking to us next. Guys, please do send your questions. So if you don't mind, because of the time restrictions and everybody, I want to get everybody talking. If you don't mind staying on so that when your questions do come through, then I'll just bring you back on stage. I'll take you, so we'll just have a more interactive conversation in you answering some of those investment questions. So guys, you can use the questions tab to be able to ask Ess any investment questions. But to wrap up with you, Ess, just talk to me a little bit about the different available options. So you already said a little bit about ETFs. You also spoke about something that piqued my mind, which was investing offshore and investing in South Africa. And then talk to us, what is then the difference between ETFs and a unit trust?
So okay, so I'll start with the difference between a ETF, exchange traded fund, and a unit trust. So a ETF is managed by a fund manager, so a core share, a Satrix, and it's more passive. So they've already sort of put together different, the top companies that they want based on their fund strategy, and that particular fund strategy, like your Satrix top 40, they have the top 40 companies that they have in there. They have a fund strategy which is passive, whereas unit trust is more active. So it's usually managed by a person on the other side that's actively sort of interchanging some of what that unit trust is composed of. So I like to think of it as more active. It's not as stationary as it's not as passive as an exchange traded fund. That's the main key difference, just on a high level. And because passive is usually cheaper compared to a unit trust, because it's active, there's someone at the back dealing with this unit trust. It's usually considered a bit more expensive. So it just depends on the unit trust that you've invested in. But that's on a high level, that's sort of the difference. ETF, passive, unit trust, more active, a bit more expensive, ETF a little bit cheaper. So those are the main differences. Now, the world has become more global. The likes of, there are different brokers. I obviously punt easy equities because of the fraction of being able to buy a fraction of the shares. If I only have 5 Rand, I can buy a share that's 100 Rand. With my 5 Rand, it will be 0.00 something of a share. So hence I like easy equities. But you can use any broker. I mean, there are various brokers that are available, and you can sort of buy and sell online using different brokers. I like to use easy equities because of the fractional investing. Now, when you're investing, there are 2 things that you when you're buying a share. Basically, the share price growth over time and dividend income over time. Now, you want to make sure that you sort of balance the 2 depending on your risk appetite. So exchange traded funds, there are over 83 exchange traded funds on the JSE. There's a lot of them. You just need to decide which one is best for you depending on your risk profile. And I like what there's this thing that you don't have to buy individual shares if that's not for you. If your risk profile is not, if you're not a aggressive investor, that's fine. You can buy exchange traded fund, and I know there's a book called Simple Path to Wealth by J.L. Collins. He basically says you can just buy exchange traded funds, your Satrix top 40, which is the SA exchange traded fund, or you can buy one like a Signia, for example, 4IR ETF, and that's fine because over time, because an exchange traded fund is exposed to equity, it will grow above inflation. And when you're investing, you want to make sure your money is growing above inflation. I think inflation is around 4% at the moment, and you want to make sure that because you're investing, you want your money to be growing above 6 to 8%, or even 8 to 10% if you can. Just to wrap up. Know what you're investing in. If the company, how do you choose a company? When you're buying a share, you're buying into the strategy of the company, into the future earning potential of the company. So it's not now have they performed, which is great. You want to understand how will they make money in the future? How are they growing their revenue streams? What is the company's strategy? What is the industry? What are the sectors that are growing? Right now, the sectors that are growing, we know it's your cryptocurrency is growing. You're looking at metaverse, this online way of looking things. Facebook has changed their name to metaverse. So it's a big thing that's going to happen. How are we going to be, using those goggles to buy things in the future? Online gaming is big right now. On YouTube, it's very big. What is that looking like? What are the future industries that have got growth? I've got potential for growth. And those are the companies that I look for. And then I look at the companies in the industry to say, okay, this industry is going to be growing in the next 2 years. These are the companies that are in that. What is their competitive edge? Then I'll choose one. I'll not only invest in South Africa, I also invest in offshore on the New York Stock Exchange through Easy Equities. I buy companies like SEA, like C. Basically, they're involved in gaming, they're involved in online shopping, they're involved in a whole lot of those companies that in the future, basically NVIDIA manufactures chips. I'm sure you've known with the impact of COVID, chips that are found in our computers, in our cell phones, in cars are in shortage right now. So the share price of NVIDIA has just skyrocketed. I mean, I've literally made 100% of my money back by investing in NVIDIA. So those are the industries that I'm interested in. What are the future industries? Because when you buy a company, you're just not buying the share price, You're buying the future earning ability. The share price will catch up. The share price of a company will catch up as long as they're in the right industry, they're in the future, in what the future looks like. They're in an industry, they're playing in an industry where the future looks great. Management, what does management do? Who's the management? What experience do they have? NVIDIA has a great CEO, a visionary CEO. I like that about them. So those are the things you want to look at. You also want to look at revenue. You want to look at the margins that they make. Are they making cash? If they're in a growth sector, they won't be making cash, but you see a lot of investments in their balance sheet. They'll be investing quite a lot. If you look at the balance sheet, you want to look at the debt to equity. How much debt does this company have? How much equity do they have? Cash flow. Are they generating enough cash before paying, operating expenses, before investing in investing activities? At the end of the day, does this company have enough cash to do what they want to do in terms of investing in the future? And you want to make sure that those companies, you're investing in such companies, and they mustn't have too much debt. If the company has got too much debt, just know that they won't have enough money to invest in the future, and therefore their revenue might not grow as fast as you want. Sorry, Nicolette, I know I've gone overboard, but that's my high level.
I absolutely just love the way you simplify investing into the stock market, and it's really great to listen to you because you simplified so much. So I'm just going to leave you with these two questions as we bring Salem on stage. One of the most important questions that keeps coming up is around how you put together your dividend strategy. So first and foremost, which platform did you use to identify your dividend paying stocks? And then secondly, how do you know when a company is going to be paying dividends? If you can just hold that thought for me, I bring Salem on board, we get into a little bit of a debt conversation, and then we'll circle back to you. Ess, the other question is your top 5 books that you are reading that you can assist or share with us. I know we've already shared, I think, J.L. Collins. I don't know if I've shared the right book, or I think that's his blog that he works on. So please, if you can, just hold tight for us, Ess, we'll come back to you. Thank you so much, Ess. I really appreciate your time also. I think that's really something that I need to put out there. It is a Saturday, guys, and I heard it's a big weekend. I didn't know it was a big weekend, or else I wouldn't have scheduled this money check on a big weekend. But I'm so glad everybody is here, and it shows how much people really do care about their personal finances. So let's bring in Salem Nyati. Salem, talk to us a little bit about, and I'm going to jump straight into Salem. I think I've done a couple of these sessions with Salem before, so you guys definitely know who Salem Nyati is. So I want to get straight into what is the status, Salem. Good morning, first and foremost. But what is the status of household debt in South Africa right now? If you can just unmute your mic for me, ma. Your mic is still off, Salem. Yes, you're on mute. So just unmute yourself, please. Okay, I'm struggling to hear Salem. Can anyone else hear Salem so that I make sure it's not on my side? Okay, we'll get Salem back. Ess, can you just quickly come back for me? And we can have a conversation around your dividend strategy if you are still there. So yeah, thank you, as we're still sorting out Salem's technical issues, if you can maybe answer that question around where do you, first and foremost, how do you identify that a company is a dividend paying company, and where do you check that they actually are?
Okay, so I use, there's this, I'll share the link on the chat, but there's this dividendrankingsa.com that I usually go to, and it will usually list I think it's the top 10 companies in South Africa that pay dividends. And then I then go to each individual company and look at the performance. So your usual suspect, like your Kumba, Exaro, MTN, Vodacom, British America Tobacco, they pay quite good dividends, and your properties. But I know properties had quite a bit of a rough patch the last few years, but they're slowly, hopefully with COVID and everything going back, hopefully in the future they'll reinstate some of those dividends. So your miners are known to be good dividend payers. Your coal miners, I know, and then I also look at their dividend policy. So a company will usually have dividend policy on their, if you read their financials, they'll usually have, I know Kumba, and don't quote me on this, I think they pay over 50% of their cash back to shareholders. So that's a great dividend policy, because you know that they love to pay shareholders money back. So that's how I sort of filter. First, dividendranking.com. I go there, check my top 10, and then I deep dive into each individual company to say what is their dividend. Any dividend policy that has above 4%, any company that has a dividend yield of above 4% is a good dividend payer in South Africa. In the US, it's slightly less. Anything that pays above 2% is considered good in the US. And the US, at least, they have companies that pay, or Etfs that pay monthly dividends. So I have one of those there. In South Africa, mostly pay twice a year, depending on the performance. So usually what a company would do is, if they've performed well financially, the board will declare that the company will pay a dividend. If they have enough cash after they've paid everything and they've got enough cash in their kitty, the board will say, okay, we have enough cash, we don't need this cash to do other things, so we'll give it back to shareholders. So usually when companies release their financial statements, you will see they'll talk about dividend, whether they're declaring a dividend or not. And you want to make sure when they do release those financials, you check whether they're declaring a dividend or not, and how much, because that's very important. If they're declaring 70 Rand per share, you then multiply that 70 Rand, multiply the number of shares you have, then you know that amount will come to you less 20%, because you pay a dividend tax of 20%. So you take that and you say less 20%, that's the money that will come to your pocket. And for me, I always reinvest my dividends, because I'm building my portfolio for the long term. So I reinvest my dividends. I don't take them out of the portfolio. I just reinvest in a company that I think I want to grow my holding in.
So when I teach my little kids, I always say, don't eat the chicks. So when your chicken has baby chicks or the eggs, don't eat the eggs, because you don't eat your interest, right? And it's the same thing with dividends. You've got to look at your dividends as the next way in which you are actually going to build your actual wealth, and it's using those dividends. Thank you so much, Ess. Please do still hold on for us, because there's still a whole lot of questions that are going to be coming up when it comes to investing in the stock market. But I think generally you've got such a great and a well-versed information and knowledge when it comes to investing. So please do hold tight for us. Let's bring back Salem.